Hello, and thank you for joining me for our short session on understanding accounts for non-accountants. This is part 3 of a 3-part series where we're uncovering the myths and busting the jargon on understanding accounts, specifically for non-accountants. My name is Paul Samra. I'm a partner at Moore Kingston Smith, Chartered Accountants and Business Advisors, specializing in owner-managed businesses and the not-for-profit sector. I hope you enjoy this session and find it helpful and informative. So welcome again for part 3. In part 3, we're going to cover coping with the jargon, a bit more jargon, I'm afraid, principally centered around the balance sheet. We're going to look at how you should read a set of accounts and analyze the figures, and then a quick slide on liquidity and solvency, particularly relevant in these days where sadly, as a result of the pandemic, we are facing more business closures than perhaps ever before. Now, the balance sheet. Balance sheet is the one area that I think people really struggle to comprehend. I'm not going to go into why a balance sheet balances. That's for another day. But what I wanted to say was you'll see that on any heading of a balance sheet, the words that follow balance sheet will be as at, and it's as at the accounting reference date. So balance sheet as at 31st December 2020. Balance sheet as at 31st of January 2021. And these images that you've got here, animated images, merely serve to demonstrate that it is a snapshot in time. It is click, picture is taken as at the 31st of December or 31st of January. If you took a picture a week later, the scenery would be different. So what does the balance sheet actually have? Well, the balance sheet includes fixed assets, and they are assets that last longer than a year. Long life assets, typically buildings, of course, furniture. You go out to IKEA and you buy a load of office furniture. That office furniture is not disposable. It's going to give you a life of furniture of longer than a year. Fixtures, lighting, computer equipment, laptops, vehicles, cars. For charities, you might have heritage assets, such as stained glass windows. And then the big thing that was the key of the 1980s and onwards, intangibles, such as valuing a brand, Kit Kat, Marathon. Oh, sorry, that's dating me. It should be Snickers, shouldn't it, really? But intangibles, those that you can't really see, goodwill. And that's where the auditors have had difficulties, I think would be the way of putting it, in years gone by, because of course, you know, they're signing off on a set of accounts, and if those intangibles are overvalued, then there could be significant implications for both the business and the auditors for signing off on that valuation. So tangible assets such as buildings, cars, land, furniture and fixtures, equipment, and intangibles such as a goodwill, branding, and the like. Now, fixed assets have a limited life. There will always be a measure of wearing out, depreciation, in other words, wearing out, usage and obsolescence. So even though a building has a long life, actually it does depreciate over a period of time. And that measure of wearing out, usage and obsolescence is called depreciation. You can charge to the profit and loss account any rate of depreciation you so choose. It's not tax allowable. So even though you might depreciate your car at 50%, so that over 2 years the value is 0, I'm afraid you won't get to that full 50% allowed against your profits. Accounting profits are one thing, that's after depreciation. Taxable profits excludes depreciation. Depreciation can be straight line, i.e. 25%, i.e. over 4 years, or it could be reducing balance, which means the depreciation rate, say 25%, is on the reduced sum. So if you have an asset of £1,000, depreciation year one is £250, you're then left with £750 of value. And then the depreciation 25% reducing balance is 25% of 750. So it never ever tapers to zero, but it gets lower and lower. So that's depreciation. You'll see depreciation in the profit and loss account, and you'll see the depreciation figure in the notes of the accounts under fixed assets, because it would have been deducted from the cost of the assets. Because over time, we have to bring in an element of wearing out, usage, and obsolescence. So that's depreciation. Within the balance sheet, you've got fixed assets we've now covered off. We now come on to current assets. And those current assets are assets, they're good things, assets, that can turn into cash reasonably soon. So within 12 months, they can be turned into cash. Typically, you'll find stock and work in progress, depending on the type of business that you're looking at. Stock, you're looking to turn over that stock into cash within a year, and work in progress. So if you're a profession that charges time for your time, you might well have a load of timesheets on which the bills have not yet been raised. That would be work in progress. Debtors. Debtors are people that owe you money. Debtors are good things because they owe you money. And you'll look at that, and you'll look at those debtors, and you'll say, maybe you've got a few that are really a bit old and long in the tooth. Are they really going to pay you? Should you actually write that money off and say, actually, it's no longer recoverable? Debtors. Prepayments. Prepayments are things like insurance premiums or telephone rental, where you're actually paying for a service or a good up front. You haven't yet received the benefit of that service because it extends past the year end. So, for example, if your year end is 31st of December, but your insurance renewal comes up on the 31st of March annually, then you'll have actually prepaid 3 months worth of insurance, because come 31st December, you've actually already paid the 3 months remaining on the insurance policy. That's what's called a prepayment. So it's something that will go towards your next year's accounts. And then finally, under current assets, cash at bank and in hand. And that's basically your bank statement balance of all your accounts, assuming they're in the black and positive. Cash at bank and in hand. So there might be money in the till or money in the safe that hasn't been banked at the year end, plus your bank balance. Current assets there, fairly straightforward, but we're starting to get into the real jargon, I'm afraid. Debtors, work in progress, prepayments, all the words that your accountants will band around at a client meeting, and you're meant to have understood what they are. Creditors and creditors, these are amounts that you have to pay. Creditors, amounts falling due within 1 year. Now, if you go to the cash point machine and you check your balance, you'll get the little slip of paper coming out of the machine, and it will hopefully say £500 CR. That is because the bank have you as a creditor. They owe you that £500. If the slip comes out and it says £500 DR, you are their debtor. And remember what we said about debtors. Debtors are people that owe the company money. So if it comes out £500 DR, then you are a debtor to the company. You owe the bank, in this case the bank, £500. But let's assume that you've just been paid and the amount says £2,500 CR. That's the money in the bank. Right, so creditors. We have to disclose creditors, splitting it between amounts falling due within 1 year and amounts falling due more than 1 year. So we start off with bank loans and overdraft. So it's just the element of the bank loan that you have that is repayable within 1 year. So it's to show effectively current creditors. And we also include here the bank overdraft, because technically the bank overdraft is repayable on demand. We have trade creditors, so these are your suppliers who you owe money to. Other creditors could be directors who have loaned the company money and are due it back. Corporation tax, the liability that's due 9 months after the year end. Social Security and other taxes, that'll be PAYE and VAT would be in that little line there. So it's what's been paid probably after date for the previous month, paid if it's got a December year end, probably paid in January, and that will be December's payroll taxes, and the VAT for the quarter ended 31st December would be there. Accruals and deferred income, let's take those in turn. Accruals will be an amount that's is payable, but you haven't had the invoice. It hasn't been processed within your bought ledger or your purchase ledger. Typically in accruals would be your audit fee. So you're expecting the bill after the year end, but it does relate to the year you're looking at, so therefore should be brought in as a debt that you have to pay. Deferred income is where you've actually invoiced for something up front and the service actually is deferred until the following year, because it didn't relate to the year under review. So actually it's deferred income. Then whilst we have creditors falling due within 1 year, we have creditors falling due after more than 1 year. Bank loan, so that's the residue of the bank loan over and above the 1 year, first year element that is likely to be paid off and dealt with within creditors amounts falling due within 1 year. Other creditors, you may have directors who have loaned money to the company, but are quite happy to defer repayment, maybe repaid in 5 years' time. So continuing on with jargon, called up share capital, you'll see on the balance sheet, and that's the nominal value of shares that were issued. Revaluation reserve, that picks up on any revaluation of fixed assets you might have decided to put through over and above the cost. And then charities have restricted and unrestricted funds and designated funds. Restricted funds are for the purposes of the donor has specifically said for what purpose the money should be used for, or you might have set up a special fundraising appeal where you're collecting monies for the church roof, repairs to the church roof. So the monies would be solely used and allocated for church roof repairs, not for the general running of the church. Designated funds are those effectively matched by the fixed assets, the building. Partnerships, partnership will have on their balance sheet capital account and current account. Broadly these days they tend to be one and the same. It's just the amount that is owed to the particular partner. You might have segregated your capital account from your current account to actually reflect fixed capital, whereas the current account has the movements year on year. But that's what's included on a partnership set of accounts. Now we come on to analysing a set of accounts and looking at it from a point of view of ratios. And we've got here on some of the slides that follow some typical ratios that you can use depending on the type of business you're looking at. Gross profit margin, look at the sales less the cost of sales over the sales, multiply that by 100%, and we want that to be as high as possible. We don't really want it to be only 20-25%, because it's unlikely that with that low gross profit margin you will have enough gross profit to cover your indirect costs, because that's the key. Stock turnover, how often do you roll your stock over and get paid for it, get the money in? Average stock value over cost of sales. The average stock value is the opening less the closing divided by 2. The average stock value is the opening plus the closing divided by 2. That's the average stock value over the cost of sales times 365 days. So we want that to be low, because that indicates that you are turning over your stock, converting it into cash quickly. Trade debtors, the recoverability of debts. Closing trade debtors. Now, your trade debtors will be gross of VAT, and so therefore we should be looking at this ratio in terms of gross sales. So you will need to multiply the sales in the profit and loss account by 1.2 to get your gross of VAT, and we want that to be as low as possible, because we want you to recover your debts, the sales. Your customers are want to pay you. We want them to be paying quickly. So we want that as low as possible. Trade creditors is the reverse, in the sense that we're looking at trade creditors and how quickly you pay your trade creditors. I haven't put an arrow there because you might want to extend the amount of credit you're giving or taking from your suppliers. Other than your auditors. And now some notes on liquidity and solvency. So you're liquid if your current assets exceed your current liabilities. So remember where your current assets sit on the balance sheet and what they are: stock, cash at bank, debtors. So those current assets need to exceed your current liabilities, the liabilities that will fall due within 1 year, in order for you to be able to pay them as and when they fall due. You are solvent if your total assets, so that's your fixed assets, less your fixed assets and your current assets, exceed your total liabilities. So exceed your creditors within 1 year and more than 1 year. So if your total assets, fixed and current, exceed creditors less than 1 year and more than 1 year, then you are solvent. But you are insolvent if your total assets are less than your total liabilities, and in which case you need to be very mindful of not trading whilst insolvent, because that is potentially a fraudulent act. So do take advice if you are looking at a set of accounts that have just been prepared and your total assets are less than your total liabilities. That is not good news, and you need to take professional advice. Okay, I think that wraps it up. End of part 3. I hope you found these little mini videos helpful and informative, and they're my contact details, and please do look at them again and pass on our details to anyone else who would like to understand more about accounts, and hopefully I've done my best to demystify some of the myths and jargon surrounding accounts. Thank you for watching. Goodbye.